All right, we're going to start with exercise number 8. It's on page 29. So, exercise 12-8, page 12-29. And on this one, Cressman Company incurred R&D costs for various projects in 2013. So they had a whole slew of, and what they've done is they've broken it out between the material, the personnel cost, outside consulting fees, and the indirect costs that were allocated to both research and development. So they separated it because it's asking you what is the amount under U.S. GAAP, but what would the answer be under international? So that's the reason it's all broken out there. So just starting, and we'll just do the U.S. GAAP first. We've got materials. We have personnel. Consulting. And indirect. As well as, well, we've got some equipment. That was purchased through the year. So we've got research. And then development. And a total. All right, so materials that were pulled out of inventory for the R&D endeavors in the research phase of it was 240 and an additional 160 once we got into development. And remember, research is the search for new knowledge, new products, new processes. Development is taking, God bless you, those identified opportunities and actually converting them into a commercially viable endeavor. So for research, we've got 600 in personnel cost with an additional 400 for development. That's $1 million. Outside consulting is 80 and 20. That's 100. And then indirect is 130 and 70 for 200. All right? So the question is there's a piece of equipment that was acquired for a total cost of $2 million that will have alternative uses in the future research projects for a 4-year period of time. So if the equipment has an alternative purpose, we capitalize it and depreciate it. If it doesn't have any alternative purposes, then we expense the entire cost of the machinery as it's incurred. All right? So this one does, so we're going to put 500. So under U.S. GAAP, we have $2,200,000. The research phase of it under IFRS would be expensed, and so if you include the 500 here also, you wind up with $1,490,000, and they would then capitalize $710,000. Yep. If a fixed asset, a long-term fixed asset, has an alternative use. So in other words, you're buying, you're buying this piece of equipment Bless you. My goodness. You're buying this piece of equipment and you're going to use it across multiple projects, or a good example is you buy a really large oven in order to bake composite materials in it. Composites that you make the airplanes, the new airplanes out of, the plastic ones like the 787. It requires a really, really large oven because you put layers and layers of resin and material down. You form it into the shape that you want, and then you shove it in an oven just like you're baking a piece of pottery. And then you bake it, and it becomes harder than aluminum once it's done. So that piece of equipment can be used in the production phase, not just the research and development phase, because you need that equipment for multiple purposes. In that case, US GAAP and the international community, so they're consistent there, allows you to capitalize, because these can be, hundreds of millions of dollars for one the size of a building, capitalize it and then depreciate it over the life, all right, which in this case, 4 years. If it doesn't have an alternative use, so in other words, you're buying a piece of equipment that, ultrasounds or x-rays these composites during the research phase in order to make sure that as you stress them, they don't form little micro cracks and eventually fail. So you've bought a piece of equipment specifically for the purpose of testing only. It will have no purpose whatsoever once you get into production phase. Then that machine you have to just write off the moment you buy it. So that's just the rule. Does that make sense?
So where would that go on here?
If it didn't have an alternative use, you'd have all 2 million of it in here. And so this would be 3,000,007 rather than 2,000,002.
So 500 is coming from that 2 million. Okay.
Correct, because a 4-year life, straight line, no salvage value, so 500 a year. Okay? Does that make sense? All right. That was a good introduction. Let's do problem number 12 on page 30. So on this one, it's giving you a series of transactions that have occurred throughout for Brush Company throughout 2013. So there's 5 transactions, A through E. They want you to not only prepare the journal entry to record the transaction itself, but subsequently record the year-end entry to amortize or adjust or whatever year-end entry is necessary. Okay? So let's just take them one at a time. On A, we purchased a patent for $70,000 that had originally been filed on January 2007. The purchase was made to protect another patent that the company had filed for in January 2009 and then subsequently received. So on A, what's the debit? What are we buying? Right, that's the category, but specifically we're buying a patent. For $70,000, and we're paying cash. Oops. Credit. Now I'm going to skip down because there's a related transaction to this. Number D, item D, paid $28,000 of legal costs to successfully defend the patent that was acquired in transaction A. So if you successfully defend a patent that you own, you can capitalize that defense, right? What if you had not successfully defended the patent that you had in A? You would then write this whole $70,000 off because you've got a useless patent, right? All right, so we're going to capitalize D also to patent. For the $28,000. So now, when we get to the end of the year, what adjusting entry needs to be made at December 31st? What are we going to debit associated with this now $98,000 patent? So amortization expense. And your credit can be either one. US GAAP allows you to either use a contra asset account, accumulated amortization on patent, or in the case of intangible assets, you can just write down the asset account itself. So for simplicity, we'll just credit patent. Okay? So, it doesn't give you a useful life, so we'll default to the legal life. What's the legal life remaining on this patent? Patents are good for 20 years. God bless you. So if patents are good for 20 years, how many years has this patent been in existence? You bought it in 2007, it's now 2013. It's been in 6 years. So if you take the 98,000 and divide it by 14, that's the remaining life, you get $7,000. Everybody understand that first one? Yes? I know it's cold and rainy today. Number B, we purchased the rights to a novel by a best-selling novelist in exchange for 10,000 shares of $10 par value common stock that is currently selling for $60 per share. The book is expected to sell 1.5 million copies over the next 3 years, with no significant sales of the novel expected beyond that 3-year period. So what are we buying here? Go back to my 45-second rule. Did I say that in this class? Research has indicated it takes 45 seconds for the average college student to formulate a question, an answer to a question, and then actually screw up the nerve to blurt it out. The average college professor waits about 8 to 10 seconds before they answer the damn question themselves. I mean, it's a bad habit. It just perpetuates. So what are we buying here? Think of the intangibles that we got. Are we buying a trademark? Are we buying a patent? Are we buying a trade name? We're buying a copyright. Thank you. And we're paying, oops, not cash. Common stock. At a $10 par, and we're 10,000 shares of stock is 100,000 in par value, and it's currently selling at $50 over par. So additional paid in capital is $50,000. So that's a total of $600,000 worth of value that we are purchasing this novel for. So the year-end adjustment is the same, amortization expense. And copyright. So we've got $600,000. The legal life is 70 years after the death of the author. Well, what's the useful life, in essence, for this novel that we bought? How long do we expect to generate revenue? 3 years. So $200,000. Number C, purchase the franchise to operate a ferry service from the state government for $10,000. A bridge has been planned to replace the ferry, and the bridge is expected to be completed in 5 years. Brush hopes that the ferry will continue as a tourist attraction, but the profits are expected to be only 20% of those earned before the bridge is opened. So this is a franchise that we're paying cash for $10,000. And at year end, we're going to amortize this franchise. $10,000 divided by how long have we been granted the right, or, well, we've been granted the right for, doesn't say, but how long do we expect to generate significant revenues from this ferry operation? 5 years. Because once the bridge comes up, we're going to continue to operate it, but matching, we need to generate, if it's going to fall off by 1/5, of what we were doing before, a mere 20%, we need to do this and expense it during the peak revenue before the bridge is opened. And then E, so that's a similar thing to the North-South Padre Island, or North Padre Island, So once they open the bridge on the south side, but then, do you all recall, do you remember, you were old enough when they had a barge run into the bridge? Yeah, like 3 or 4 years after the darn thing was open, a barge broke loose in the intercoastal waterway there and slammed into the bridge, shut it down for another year while they fixed it. So everybody had to go back and forth on the ferry again. So maybe it was the ferry operator that cut the barge loose. So it was pretty funny. All right, E, paid a race car driver $50,000 to have Brush Company's name prominently displayed on the race car for 2 years. So now what are we buying? We're buying advertising, but we're prepaid advertising. For $50,000. And at the end of the year, we need to take it to advertising expense. reduce the prepaid. $25,000. Okay, everybody got this? All right. Let's do one more. Problem number 5. On page 34. So Bailey Company was formed in January of 2011 and is preparing its financial statements under GAAP for the first time at the end of 2013. That in and of itself ought to frighten you. 2 years later. 3 years later. The general ledger at the end of the year includes the following in the intangible asset section. It's got a patent, a copyright, a trade name, some computer software, some startup costs, some intellectual capital, and some goodwill. As the recently hired accountant for Bailey, you've been asked to make sure that the company's accounting for intangible assets follows GAAP. And then based on your investigation, you determine the following. So we'll just take them one at a time. The patent was acquired in January of 2013, the current year, and has an expected life of 15 years with no residual value. It would generate approximately equal benefits each year. So on the patent, you're going to amortize and write down the patent. So you've got $120,000 that you spent at the beginning of the year, and it is expected to have a useful life, even though it may have a legal life beyond that, a useful life of the next 15 years. So that's $8,000. Bless you. The next two, both the copyright and the trade name, this company, Bailey, is expected to use those for the foreseeable future. So there is no expectation of a write-down needed on either one of those. So you can just leave the 140 because both copyrights and trade names, even though with copyrights you have to renew them legally every 10 years, you have the rights to renew them indefinitely. So Nike and Coca-Cola and McDonald's and all that, they get to use those trademarks and copyrights forever. All they got to do is every 10 years pay a little bit of fee to the U.S. government. All right? So down to the computer software. You've got $90,000 in computer software in the general ledger. It was purchased also in January of this year. It is used in Bailey's 20 offices around the country. However, it is expected to be replaced with new software at the beginning of 2015. So 2013 and 2014, you're going to use this software, at which point in time you're going to upgrade and migrate to a new system of some sort. All right? So this is going to be amortization expense. And then we're going to write down computer software. So we've got $90,000 in this. And we're only going to use it for 2 years. So we'll write off $45,000 per year for 2013 and 2014. And then in 2015, we'll migrate to the new system. So not a great investment, but that's what they decided to do. Here's a personal favorite. Bailey previously capitalized the expected value of its human resources as intellectual capital with a corresponding increase in additional paid-in capital. So at some point in time, some enterprising executive decided we've got a lot of value in the people who work for us. Let's put that value on the balance sheet. You allowed to do that? It's not only don't think so, absolutely not. You're not allowed to do that. You can't just create assets out of thin air. All right? And somebody in yesterday's class went, what if you did it this way? And I said, I need to make sure that I'm on LinkedIn with you so that I can follow your career throughout the next 20 years and continually sell short any company you go to work for. Sooner or later, you're going to get caught. And at that point, I'll make millions on my investment. So we're going to reverse this one. We're going to debit additional paid-in capital. And we're going to zero out this fictitious intellectual capital. And they went whole hog, $150,000 worth. Not bad. Not U.S. GAAP, but creative. All right. The last bullet point, a trade name, well, the trade name and goodwill arose from the acquisition of a subsidiary at the end of 2012. Because of significant adverse changes in the market, you've decided both assets are impaired. You estimate that the fair value of the trade name is now $50,000. So let's just take that. You've got a trade name on the books for $150,000 that you acquired when you bought this subsidiary. For reasons in the marketplace, or maybe there was a defective product or some bad press or whatever, you now expect that the value associated with this trade name has been impaired. So you've made a good faith estimate, and you now have a loss on impairment. For the trade name. And that's going to be the difference between the book value of $150,000, the carrying value, and the current fair value. And then the last one, the subsidiary company, which qualifies as a reporting unit. So in other words, you've been maintaining separate books on it over the life of its operation, has a book value of $500,000, including the goodwill of $90,000. So of their $500,000 book value that you have in this subsidiary, and that's just all of the assets minus the liabilities, it has 500,000, 90,000 of which is goodwill. You estimate that the subsidiary's fair value at the balance sheet date, now on December 31st, 2013, is only $300,000, of which $250,000 is allocated to its identifiable assets and liabilities. So the way goodwill, if you recall from our conversation on Tuesday, is that the way goodwill is calculated is you take all of the identifiable assets at their fair value. So cash is always equal to cash. Receivables are normally also the same as their book value, or at least their net receivable, less any allowance for bad debt. So inventory gets stepped up, property, plant, and equipment gets stepped up, any intangibles that they may have owned, maybe they've got a patent that they didn't have a value to, but you're placing a value on it during your calculation for the acquisition. So all of that gets calculated. You paid $500,000 for it, all right? 90 of it is goodwill. So that means that all of the net identifiable assets, the fair market value of all the assets you acquired, less any liabilities that you assumed, was $410,000. Does that make sense? So at purchase, or at acquisition, you had net assets, ETS. So that's total assets at fair market value less liabilities was $410,000. The purchase price was $500,000, and that's what generated your $90,000 of goodwill. All right? Goodwill has to be examined on an annual basis for impairment. And the way you do that is you go take a look at the subsidiary as of the balance sheet date, as of today. So at December 31st, (2013) now, net assets equals $250,000. All right, so you do the same calculation that you did when you bought the company to begin with. You go through and you look at all the inventory, and you've got an inventory fair value is really easy because you've got from your purchasing department what the last unit cost you, so you can easily take all the units in inventory, multiply them by the last purchase price, and that gives you the fair value of inventory. So it's not a hard calculation to pull out of your system. Assets, property, plant, and equipment, a little bit more difficult, but you've got a general idea at all time what things are worth. So you make a calculation and you come up with less the liabilities that the subsidiary currently has on its books. you come up with a net asset figure now of $250,000. If you were to redo the calculation that you did back when you bought it at 500, and a lot of times this is a discounted projected net income over the next 5 years. That's a common way of valuing closely held corporations. So if it's not a publicly traded corporation, which more than likely it isn't if it's a wholly owned subsidiary, you would just take the next 5 years of projected net income, discount it back the same way you did back in 2012 when you bought it, and now you came up with a fair market value of 300. So if you were to do the calculation today, you would only have 50,000 of goodwill. So you have an impairment loss on goodwill. And you'll write down the goodwill account. Does that make sense? So for homework, you have 12-8. This is the last homework due Sunday, as well as the last quiz. And so you have 12-8, and it's much more simplified than what I did here on the board. There's a patent and a trade name. So it's just asking you to calculate the expenses for 2013 on those two items, the trademark and the patent, and then prepare the intangible assets section of the balance sheet. So just on those two items. All right? Questions on this? No?